Okay, welcome everyone. We'll start our lesson one. Today lesson will go through LO1. As a couple of you know me, my name is Anjum Satta. If you have any question, please drop me email anjum@ukversity.co.uk and I'll try my best, get back to you as soon as possible. So today lesson will go through our LO1 and we're starting a new subject, which new module is corporate reporting. Okay, before starting, we'll go through the unit content, what we're supposed to learn. Okay, I'm just sharing with you. Okay, guys, anyone, any question before starting? If you have, please, very welcome. Okay, welcome everyone. Okay, so we're looking unit one, corporate reporting for strategic business, and this unit really is all about enable student to examine the corporate reporting from the number of perspective. Thus we'll go through completing this unit and we'll discuss various accounting standard. We'll go through international financial reporting standard, international accounting standard board, and how we can prepare the financial statement. So we have the learning outcome one today, which will go to understand the fundamental ethical professional principle in relation to accounting standard, which will go through. We have 3 assessment criteria under LO1, explain important of professional behaviors, why is important. Then we'll go through second is the analyze the ethical requirement. That's 2 assessment criteria we have. Second lesson will go through understand the appropriateness of the financial reporting framework, which we look 2.1 is application of financial reporting, and we'll look around the certain. And lesson 3 will go through prepare the financial statement group of entities, and lesson 4 will go through interpret financial statements. So that will be the key. Okay, LO1, which is learning outcome, ethical and professional principle related to the accounting standard and corporate reporting. We'll go through 5 professional code of ethics, which is popular people chat in office. First, we'll go through professional behavior, professional competencies and due care, confidentiality, integrity, and objectivity. We'll discuss, different accounting bodies, and we go through international accounting standard. International accounting standard 1, which is about preparation and presentation of financial statement. 4 types of financial statement we prepare. Statement of comprehensive income, which is income statement. Statement of financial position, which is balance sheet. Statement of cash flow. Statement of change equity. Okay. Second statement, and that's which we will go through. The second international accounting standard, which is inventory. Inventory should be recorded at cost or net realizable value, whichever is the lower. Third is the statement of cash flow, which is operating, financing, and investing activity. We look the cash and accounting principle or policy. So always, accounting estimate and errors, and the policy should be consistent. And the LIS 10, which is about event within 90 days, the report should be published within when the year end. And the IS 16 property plant equipment, different depreciation method, revaluation method, all will go through. IS 15 is about revenue. If you're doing the contract, revenue should be recognized in the financial statement on the basis of accrual and the proportion if it's a construction interest, because the service is being performed. And impairment is a loss, how the asset can be impaired, and we look around the carrying value, fair value, market value. That will be our economics value. Okay, then contingent liability, which is highly likely, the probability or the chance of happening, we left the case. Our asset, which is we can look around the definition about asset. Intangible, you can't see it, you can't touch it, like goodwill or intangible asset, which we look these in our discussion. So that all will be in our lesson today under LO1. Anyone, any question before starting, please? Okay, let's look, So please, if you have any question, you can drop the email. Those are listening this recording, anjum@ukversity.co.uk. So I'll get back to you as soon as possible. So please, we have the indicative content, the aim of unit, as I mentioned from the unit specification, and we'll go through the reporting standard. So please always good to be reflect how much we know already reporting standard, and then we can look around, these accounting standards which I just mentioned earlier. Okay, so first is ethics. Ethics are the moral principle. If you're a member of IFA, you will be member of our student members. You will have to follow these are the five most important professional code of ethics. Professional behavior. If you want to remember easily, so you can say popular people chat in office. Professional behavior. First, we always is non-conflicting information. True, it's not hiding or doing self-interest. That's not a professional behavior. You give the advice to for the sake of you will get back and commission. So that is we need to be true and fair information too. Okay, professional competence, up-to-date knowledge. That's why the CPD is very important. Confidentiality, keep the client information confidential. Don't need to declare until court give order or the best interest or the client will say to declare to third party. Integrity is honest, with your matters with as accountant, and objectivity is your objective as the accountant is to prepare the financial statement in the light of the financial the accounting standard and true and fair information. That's the most important. Okay, the main of accountant job to ensure the transparency, reliability, consistent comparability of the financial statement. We can standardize accounting policies and principles to maintain the nation and economy. So the transaction, all the companies will be recorded in a similar manner if they fall in accounting standards. Yes, so because international mean because the company have uh, offices throughout the world and their standards should be in line. Okay, then we had the discussion the profession and professionalism. When we say profession is a body of the theory or the knowledge and which is used to support the public interest. And public in professionalism taking action to support the public interest. So profession is accountant and professionalism is following and dealing with fairly, truly, and up to date, the information to client. Yes. So we can look around the professions and the professional taking actions and the profession's body of theory and skill, and it is common code of practice like code of ethics. Those we need to be look around. Professionalism, the member are seen to be conducting professionally, literally having a professionalism. Professionalism may be interpreted more as the state of the mind, while the professional provide the rules and the members professional must follow it. So that's like five code of ethics. Okay, so the accounting profession, over the time, the profession appears to be taking more proactive than the reactive approach. Proactive, the taking responsibility of any negative consequences in accounting practice, where appropriate amending those, the parties to remove these consequences. So we can look around the body of theory, we can look around hidden common code of value, and we can look around acceptable duty to satisfy the void and of our stakeholders. Okay, accounting standards. So we have the uh, uh ready how the these the transaction and the event should be reflected in the fair representation, comply with the accounting standards. We have the local UK standard financial reporting, statutory accounting principle, and we can look around international more because nowadays company have more. Of course, you don't have any assessment; it's a written assignment. You have to answer these questions, and you can embed some accounting standard. And we have international financial reporting standard, which is by the International Standard Board. International Standard Board before 2001, International Accounting Standard Committee used to be a lot of things changed. So conceptual framework, good to know the conceptual framework, the principle or the concept of International Accounting Standard Board, which is the live preparation and presentation of the financial statement. Objective of the financial statement to provide the information true and fair, useful, existing to potential lenders, all the stakeholders, so they can make the effective decisions and based on the information they obtain. So user of the financial statement, there are number of stakeholders. Those are user. They are interested in the asset to look. They look at the liability, the company. They look the financial position of the company, economics resources, claim, financial performance, underlying exemption is a going concern. That's all the material information is in the statement, and the financial and the company will carry on as a normal at least for 12 months. What makes financial information is useful? Qualitative characteristic, fundamental qualities. So qualitative characteristic, useful information is relevant. It is capable of making difference in decision, including materiality. Faithful represent, which is report, represent, and complete. So these financial statements need to be complete. All the information should be asset, liabilities, equities, neutral and free from errors. So enhance financial characteristic about financial statement. We need to be comparability, always 2 years figures, verifiability, what we think we can verify it is asset, we own it, it will flow the future economic benefit. Timeline, yes, every 12 months we prepare, not 1 year, 18 months, 1 year, 12 months, 1 year, 6 months. So we're not supposed to be cut down. Otherwise, comparability timeline within 90 days, understandability, yes, of course, debit and credit, categorize of asset under the correct category. And if those people have the basic understanding about accounting, they can understand. Okay, anyone, any question, please? Materiality information is a material if omitting it are misleading and could be influence the decision the user make on the basis of the financial information about the specific reporting entity. So we can look around the Company Act 2006 financial reporting standard. We can look around the definition about IFRS, International Financial Reporting Standard, the conceptual framework, true and fair legal concept, normal given complying with all the applicable regulations. We can look around the meaning and the changes over the time and the business and generally acceptable accounting. Okay, so please always good to be look around all the assets, because in accounting standard, asset is anything which owned by, which will flow the future economics, where liability is a legal obligation, equity is a residual interest, income increase the economic benefit, expenses reduce the economic benefit, contribution from its increase the equity resulting of the transfer from a personal asset to the business, distribution decrease the equity resulting in the transfer its ownership capacity to the owner or in shape of the dividend. Okay, intangible asset. So if we look intangible, the asset which we can't see it, like a goodwill under IS 38, which we can asset which we can't touch it, which we can't see it, it's a goodwill. Like the net asset figures always equal to equity. If the company is offering a buyer is offering more than the net asset figure, that's why they are offering is due to the goodwill. So always keep in mind, if you want to treat goodwill as an asset, so use the definition of asset. The asset is anything which you own it, which will flow the future economic benefit, is we call asset. Okay, goodwill. Goodwill is mean the reputation, which will goodwill is we create. Goodwill we can measure it. Goodwill can be impairment. So always, we need to be in when we'll go through the group accounts. We'll keep in mind, IS 38 and so. Okay, so please, research and development expenses. So research is the expense, and the development it can come a definition about under asset, and that's which we can treat as asset, as like we can measure reliably if we have the technical feasibility, if we have intention to complete the asset, if we have ability to sell the asset, if we asset to generate the future economic benefit, if the availability of adequate technical, financial and other resources to complete the asset, and we can measure reliably, we can increase the value of the asset. Amortization, which is useful life of the asset, can be finite or identify, or it is we can amortize. We can look on the principle of the depreciation, revaluation, impairment, and review the life annually and no longer indefinite, and treat the changes in accounting estimates. Okay, impairment, which is a loss that's come under IS 16 IS 36, asset need to be impaired if their value is carrying value in use or the market value, which we look, asset is carry on its rating, and because the financial statement should be to provide true and fair information. So when you do impairment, so you have to look at an asset should be made at lower of carrying value or recoverable amount, or we call economics value, the value when we sell it, what we can, or if we keep it, how much benefit we can produce it. So if is whichever is a lower asset can be impaired uh, of on the basis, and then higher of fair value less the cost of the disposal or value in use. So these, if carrying amount is greater than the recoverable amount, its asset is impaired, need to be impaired. If the carrying amount is less the recoverable amount, is impairment loss we have. Okay, accounting impairment. If the asset carried out as the original cost recognized immediately in the profit and loss. If the asset revalued above the treat, downward revaluation, recognize the comprehensive income net and revaluation as a surplus. The cover amount is less than the depreciated HODI, and look around the significant profit or the losses in the financial statement. Inventory, as we discussed, inventory three types: raw materials, work in progress, and finished good. Inventory should be recorded at cost or net reliable value, whichever is the lower. It means the sale value. Okay, then we can under IS2 inventories valuation method, first in first out, and FCO is allowed under the financial accounting, and LIFO is not, but management accounting we can because we don't follow the standard. IS 37, IS 37 is about the provisions which we can. Okay, guys. So what we need to look around the provision is the liability, which we can look around uncertain timing amount, which is IS 37 provision, contingent liability or contingent asset. Of course, when you treat at the contingent, look around the likelihood, the present obligation as the result of the past need probably is outflow, embedding economic benefit, is the chance of a happening contingent. It can goes like a case against the company, and the probability that if more than 60% we lose, we can create the contingent liability. So under IS 37, contingent liability is possible obligation that arise contingent asset from the past, even existence confirmed only by the occurrence, and we can more than uncertain future even. Debit not don't recognize or discuss, inflow if it's certain, then of course we can. So we can look around, does the entity have the present obligation? If yes, so we have to look around, and either we need to declare or we can single line we need to include because the financial statement true and fair. Okay, events after, when if your any transaction happen, a significant losses, a significant asset being the value. So within 90 days after the after the year end, and that's adjusting event. If it's more than 90 days, it's not adjusting event. This will we keep into the next year's or the next period financial statement. So revenue is treated as the revenue turnover and sales are the quite is similar. We can look around uh, IES 38, which is about revenue, revenue from the sale of the asset. Entity has the transfer, the significant risk, and the relevant ownership. Entity retain, neither continuous managerial involvement. Amount of the revenue can be measured reliably, and the possible economic benefit will flow. Entity and the cost of transaction can be measured reliably. Then we can recognize, in the book of account as the revenue and the proportion of the work is. So that's, which we need to be proportionate. Okay, then we discuss recognition criteria, property, plant, equipment. We can recognize in the asset, in the book of account. We need to be look around the depreciation is expense. We need to be look around the revaluation, measurement recognition, the cost, the price, the delivery charge, or the capital expenditures which we can capitalize. Okay, so we can look around the different model, costing model, like revaluation losses, and revaluation model. We can make the fair value adjustment accordingly, and the asset needs to be, because end of the day, IS1 is all about true and fair information should be financial statement. So we can look around the depreciation. We can recognize again depreciation. We look around the depreciated amount, residual value under IS 16, which is property, plant, equipment. And if we asset being disposal, the proportion the remaining should be shown in the asset. So we can look around the land, building, property are the non-current asset register, depreciation of the asset, net carrying value of the asset, beginning and the end, we can show in the financial statement. Okay, then IS 7, which is about the cash flow. IS cash flow, how much money in and outflow. There are the three activities: investing, financing, and operating. And we can use direct, indirect method. Only the layout, this is, you will see the direct method and indirect method. So indirect method, profit before tax, adjustments, the first place what you done, anything related to the operating, which is short term or the normal business. Direct method can cash receive from our suppliers and how much generate interest rate, all we can structure like this. Okay, then we can investing activity, the changes in the non-current asset last year and this year, disposal of the dividend, that's come under the investing. If we receive or the paid off, or set the liability. If the liability go up, it's finance mean the positive cash flow. If the liabilities go down, it's mean negative cash flow. These all we need to be look around. So under the statement of cash flow, which is that come under IS 7, and that's which we need to be look around all the possible activities which we mentioned: operating, investing, financing, and the cash equivalent or the cash balance should be represented. That's why it's quite important statement. And as we mentioned, 1.2, we need to be look around 5 professional code of ethics, integrity, objectivity. We follow all the rules and regulation and international accounting standard. And the threads, self-interest. If you recommending something for the sake of your interest because you have a financial interest, self-review, checking your own work. Advocacy, if you're giving advice to one client, you may be compromised, and that's you may be not objective in your profession. Familiarity, if the people know families, that can be familiarity. Thread leads to the objectivity. This the risk leads to the objectivity can be compromised. Intimidation, if your boss say your job will be raised if you don't do this, that's your objectivity or the integrity can be compromised. That's we need to be, and you have to use your judgment. Either you leave the job if you can't, or you can get the advice from IFA, the awarding body members, whichever it will be. And self-interest, of course, we can look at financial interest, close business relationship that come. And the self-review, checking your own work, which we mentioned, maybe you used to be, now we are working in different audit department. Advocacy, where the accountant take the client part, they advocate and will earn the fees from it, which shouldn't be, and that can be objectivity. Conflict of interest can be maybe you give benefit to the family, an intimidation, close business relationship, family relationship, and personal relationship. These can be leads to, and ultimately objectivity can be compromised. Okay, yes, so today we discuss about different standards. So please, we have the handout which is available on our Moodle page, Osborne handouts, chapters 6.3 to 6.4. So it's good to look around, please. These two questions that will help you to look around the standards and ethics. That's all from my end. In the next lesson, we'll go through LO2, and thanks for attending and have a lovely week. Thank you. Bye bye.